there are reasons out there to be concerned about credit. And this is what we've been waiting for more than a year. Now, why are they selling credit to retail investors? Because the institutional people don't want it anymore. They've decided they had enough. So I worry about that, Julia, because if we're really at an inflection point, I think a lot of these deals that were sold to investors on a premise of a soft landing are not going to look so great.
Chris Whalen, chairman of Whalen Global Advisors, investment banker, independent analyst, author of multiple books, and friend of this show. It is so great to welcome you back on the show. We love having you. A lot going on today, so it's great to have you on.
I didn't arrange this. This is all your fault.
I know it's all my fault. I'm looking at the 10-year treasury right now, below 4% on the yield there. We had a worse than expected jobs report today. Let's just start with the big picture like we always do, Chris, and take all the time you need to set the table, if you will.
Well, this morning, as you mentioned, we had a couple of numbers which have caused the crowd on Wall Street to start yelling and screaming even louder about a September rate cut. I think the thing that worries me, I did a piece this morning about some of the fintechs and Ares, the big credit shop. And I don't think people expected things to change this quickly. The rate of change is troublesome because if you're an investor and you were out buying retail credit offerings from your friendly mutual fund, as funds, by the way, you probably didn't expect this kind of a change. And I'm just wondering how the lenders and other participants in the credit market are feeling now that we seem to be on a recession narrative. If we're worried about unemployment, if we're worried about other factors, I think that's going to be a significant change in a lot of people's minds who weren't expecting it. You know what I mean? The systemic risk is all about surprise. So if we surprise people, we drive the 10-year down into the threes. That tells me that there's a lot of guilt and perhaps even some fear and loathing in the background here, Julia. What is everybody worried about that they drive the 10-year down that fast?
Yeah. Can you, let's explore that further. The 10-year below 4%. I'm looking at 3.825 right now.
Whoa.
Let's talk about the implications of a 10-year below 4%. What does that signal in your mind, or not even in your mind, but what is that signaling to you?
Well, if you're a lender, all of your production that was in the pipeline is now really profitable. So you're happy. You're going to have a good quarter. Everybody who had stuff in the pipeline that they were trying to sell at last week's yields are really happy. But it also tells me that there are reasons out there to be concerned about credit. And this is what we've been waiting for more than a year, especially on the consumer side. But the institutional side, I just got done spending a few hours going through Ares Financials. It's a big business development corp that sells credit to retail investors. Now, why are they selling credit to retail investors? Because the institutional people don't want it anymore. They've decided they had enough. So I worry about that, Julia, because if we're really at an inflection point, I think a lot of these deals that were sold to investors on a premise of a soft landing are not going to look so great.
Mm-hmm. Yeah, the retail investors are always like the last ones in on that trade.
Why would you sell credit to retail? I mean,
that's come up on the show. Other people have raised that concern as well.
But if you fund the loan, Julia, you own the risk. No matter what the docs say, no matter how many times you sell that loan to somebody else, you own the risk if there's a fraud claim. So that's it.
You mentioned we could be at an inflection point. Can you just provide some more color, elaborate there? What would give you that signal, that conviction that we are at an inflection point?
I think coming out of COVID in 2020-21, there was vast amounts of liquidity in the system, and there still is. You still don't have positive defaults on 1 to 4 family homes because home prices went up so much that it's almost impossible to lose money on a mortgage that was made 3 and 4 years ago because the loan to value ratio of that loan has fallen. The home price has gone up. And if there's a default, you sell the house and you give the excess residue to the homeowner. So that's been kind of, I think, a head fake for people because we looked at credit on the consumer side and it's fine. But meanwhile, the value destruction in terms of corporate credit and also commercial real estate continues. And it's not something we can see easily because these are professional markets. You don't see the headlines unless you're sitting in front of a Bloomberg like me and you look at the scroll and you go, oh my God. Or you look at their private lending, tables, or you look at the most recent 10Q from Ares and you look at all the companies they lend money to. And it's this extraordinary amount of non-bank credit extension, I think, to the corporate sector. Many of these are companies that couldn't refinance their debt, so they went and cut a deal with the credit guys. And I think that as this ripens, it could be a source of concern next year. We could have a much bigger credit event than people originally thought. Maybe 2 and 3 months ago, they said, it's going to be a soft landing, no problem. But what if it's not? What if we see corporate default rates go up commensurate with what we're already seeing in bankruptcy?
Yeah.
Okay. Bankruptcy rates are quite high, and yet we don't talk about that.
You bring up a really interesting point of like a lot of the stuff, unless you're like yourself sitting at the Bloomberg terminal looking through these filings for this data, it's pretty opaque, it's pretty private. But I imagine, Chris, like once it's kind of out there in the open or you start reading about it in like the financial press, that's when it's like, oh crap.
Well, yes and no, but most people in the media today, as you know very well, Julia, are under a gun. They have to generate 2 and 3 and 4 pieces a day. This does not leave you a lot of time to stare at the 10Q, leave it on the kitchen table, spill some coffee on it, and really come to an understanding of what's in that document, right? That's the problem. So are they going to read the 10Q from Ares? No. Are they going to read anybody's 10Q? No. They work off the press release. That's where Wall Street is today because nobody has time. Everybody was hurrying up to make money on this last kind of denouement, if you will, the end of the story in terms of the COVID period. And now where are we? We've got an uncertain election in front of us. We have a presidential candidate, Donald Trump, who wants to talk about cryptocurrencies. I don't think that's going to be very good for the dollar. But I think embedded in it, regardless of who wins in November, is going to be a difficult economic situation next year. If the Fed has to drop rates a lot, that's going to scare people. In fact, I think what we've seen today with the drop in the Treasury yields is almost, we have a rate cut now, don't we?
Yeah, it's almost like, okay, so that's pretty much been priced in. So let's talk about the next FOMC, which is the September FOMC. And there is a lot of talk about a rate cut. So my question is, I would love to just kind of hear your thoughts, your expectations there. But even if they cut rates, like what difference would that even make right now if I'm looking at the 10-year below 4%, 3.8?
Well, I think that 10 years is going to come back. There's going to be a lot of volatility in the longer end of the curve. The short end, if we could get Fed funds down to 4.5 instead of 5.5, that would give the street a little bit of breathing room. It would give lenders a little bit more breathing room. But the trouble is corporate issuers who've been out refinancing themselves, they actually are going to have, I think, seller's remorse here because they might have waited and gotten better execution. All of the corporates who've had to go to the Apollos and the Fortresses and the Ares and the rest of them, they're not going to get a lot of relief if rates fall because guess what? There are floors on most of those loans. The bank lenders that support that activity want their money. But the problem is if the obligor defaults, they're not going to get paid. So the idea of putting a floor under a floating rate loan to a troubled corporate that's gone to a business development corporation for funding may end up coming back to bite you. You might want to work with them instead of driving them into default with a minimum floor on their loan, And that floor is quite high, by the way. It's almost double digits.
I love having you on the show every month because it's so helpful. Like I said earlier, like one of those like true independent analysts. And every time I talk to you, I feel like I'm learning something along the way. And our last conversation, you were talking about like the Fed, based on the stress test of the banks, is worried about a recession. And you're talking about a difficult economic environment ahead, especially we have an election coming up, as you point out as well. Can you just kind of frame up a bit more of the economic picture, your concerns about the economic environment? Because I do feel like, Chris, you have been ahead on a lot of this.
Well, if you look at how the Fed positions the stress test, it's more about what they think than it is about the banks. We wrote a piece in the blog about this. And, essentially when I saw them putting a 40% default rate on Ally Financial's credit card book, I thought, my God, these are nice people. They don't do business in that neighborhood. But it tells you that the Fed is worried about that particular portfolio and that they might see what you and I would say is an atypical or idiosyncratic reaction to a recession. Now, a lot of the other banks, they didn't do that too. The loss rates were modest. Capital One, JP, the usual suspects. But then you saw Goldman. Goldman got whacked with a big market risk assumption in the test. And again, it tells you what the Fed thinks about that business. So today, I think the Fed is worried about what we've been seeing selectively on the commercial side, which is that there's a tendency for default rates to jump and also a tendency for what we call loss given default, or what you get post default in terms of recoveries, to fall. So when you look at people like, say, an Ares, who's out lending to all sorts of different companies, they've had very uneven results in terms of credit. They've had losses and gains. That's what you would expect to people who have to get their hands dirty to lend to private companies, right? But if we go into a recession, if I'm a bank, supporting that portfolio, I might want a higher rate, or I might want to get out. So that's what's going to change. We've had a plentitude of capital. We've had way too much capital chasing too few assets, right? When you see that retail investors are out buying credit from mutual funds, that tells you that there's not enough out there. Why? Because the Treasury is the biggest issuer. We haven't seen a lot in ABS, autos, other sectors have been kind of quiet. Corporate actually slowed down in the second quarter. So, Uncle Sam is handing you T-bills at a 5-something yield, right? But that's not enough. The street wants 15.
Okay, they just want more yield? Is that the issue? Yeah.
Well, that's why they're buying credit. But even that has gotten thin because there's so many mouths to feed. There's so many investors who are chasing that credit trade that the offered yields have gotten down in the single digits. Single digits is not enough for that trade, Julia. You know that.
Who's going to be the sucker in that one?
I think we already got them. They're just coming to the realization, but that's okay. This is how capitalism works. We shift the problem to somebody else and we run. So.
Okay. So difficult economic environment ahead with an election coming up. We have talked about the election base case for you. Curious how that has been reinforced. Has that shifted at all? I know last time we were talking about, Biden was still in the race last time we had talked. I think they just done the debate, but there had not been the assassination attempt on former President Trump at the rally in Pennsylvania, and the swap that we've seen. So there's a lot that has changed in the last month or so. So can we get your latest on the election and how that might impact the broader economy, markets? Just would love to go there.
Well, I think now that Joe Biden has stepped aside, it's a much closer race. You have a flawed Republican candidate in Donald Trump, who has good and bad, depending on how you feel about him. And then you have Kamala Harris, who is, she's kind of like Barack Obama in a sense. She materialized politically, in the Senate, did absolutely nothing, has had no footprint whatsoever in the Biden administration, which is normal for a vice president. You don't see them or hear them. But now as she comes out, she's clearly much more to the left than Joe Biden. Joe was a traditional Democrat. He's probably the last one in Washington. Kamala Harris is an explicitly socialist trial lawyer from California. And she didn't even carry that state in the primaries, remember? So I think, she's getting a bump now. She'll get a bump going into the Democratic convention. But let's see what happens come September. Because if we're in a recession scenario, the Republicans are going to be beaten on that one. If Powell cuts rates, everybody's going to then be blaming him for showing partisanship and for favoring the administration. And I've always told people, I've written this and I've told my clients, I really don't think the Fed wants to cut rates in front of a presidential election like this. That's
a really good point, because I've talked to Jim Bianco has been on this show. And I remember he was saying basically there's a a window to cut. It would have, I think, no later. I want to say July would have been like the last opportunity, or else it'll be perceived as political. So they are kind of in a,
it would have been better do it in July when there was uncertainty about unemployment. Now the media, led by our friend Steve Leisman, is trying to stampede the Fed into a rate cut, in part because I think the equity markets have lost their way. A lot of people on the street are looking at financials, which have traded off since May. They're looking at tech, obviously, which has been trading off rather dramatically. And then you have a lot of other stocks that disappointed in some way or another. Not horribly, Julia, but they just didn't have the number people wanted. And the stocks get sold, Amazon. There's a whole long list of them. They were okay, but for some reason, the street just didn't like it. And I think a lot of equity valuations had been inflated by a variety of different narratives that were going on. And now all of a sudden, we don't seem to have that support. So people are moving out of stocks into credit. There's not enough credit, so the yields are going down. And as you can see with today's rally, I mean, you can go buy that 10-year at a 3-something, right? What a great trade that'll be.
Yeah. Okay, so
just think about it. You buy the T-bills on a 5, I think, instead of the 10-year Treasury, right?
Yeah. I don't know, like, where do you want to be in this environment? I don't know if you want to go there or share, but if you can, I think the viewers would be interested.
I got out of most of my bank Commonwealths and U.S. Bancorp primarily. All of my financials exposure is essentially preferreds now. I love markets like this because if they get disrupted, you can actually go out and find some interesting deals and high single-digit returns without leverage. So that's kind of what I'm doing. I am thinking about shopping in tech. I love it when tech sells off. Makes me feel good, because again, there was way too much air in these valuations. Yeah. Now maybe we can come in and start nibbling on NVIDIA again.
Are you thinking like NVIDIA when you think of like tech where you might want to be shopping?
I got in and out of that one. I thank Jimmy Cramer very much years ago. It was during COVID. He said, NVIDIA. It was pounding the table, and I went and bought some. I made a huge gain on that. It got to be a third of my book twice.
Nice.
And I had to pare it back. So, yeah, I own some ARM, but that's sold off too. So I think this is a good time to sit back and watch, think about things you want to buy. And then, if they seem cheap enough, you come in and you start building a position again. But we've had so much fluff because of the Fed, because everyone was in equities 12 months ago, right? You were an idiot if you were in fixed income 12 months ago. But it's very interesting. When I started seeing the 13s hit, and I saw big managers lightening up on banks, lightening up on people like Mr. Cooper, which is one of the best performers in non-bank finance. A whole raft of them, PennyMac. Even Fannie and Freddie are selling off, for God's sake. People are not so sure about that trade now.
Ooh, Fannie and Freddie. Interesting. I haven't talked about that in a while, but I mean, how about that? Like, especially the two scenarios. You could have Trump or Harris in office. Do you think we'll ever see them release? Doesn't matter. Do you think we'll ever see them released from conservatorship where like they, no? Like, remember that was like a trade, I don't know, almost 10 years ago, like all the hedge funds were buying.
Of course. It was a freebie. You had this thing that was kind of sort of private, but federally guaranteed. A no risk scenario.
Why do you think it won't be released from conservatorship? Is it just because it makes the Treasury too much right now? Or like, what is there? What's the...
you see, we can't pretend that they're sovereign anymore. If we release them from conservatorship, Moody's has to rate them as a finance company. They won't rate them as a sovereign. And they can't be a AA plus unless they're a sovereign. So let's assume we're going to release them, but are we going to continue to pay Treasury to guarantee the mortgage-backed securities? Yeah. Do you think we could survive as a market if we had a sudden one rating downgrade of $7.5 trillion worth of conventional mortgage-backed securities? No. So what's going to happen is Fannie and Freddie would have to pay Treasury to wrap those securities and the new securities that they're going to issue going forward, right? That means most of their insurance income goes away. And I don't think Fannie and Freddie can survive without their insurance income. Just as issuers, they'll be like PennyMac. And they're going to have much higher pricing than PennyMac. And by the way, they're going to have the same or maybe a lower rating than JP Morgan. If Jamie offers to wrap your mortgage-backed securities deal for 25 basis points and Fannie is charging 50, who are you going to go to, Julia? Right? You take Jamie. Jamie's the biggest issuer of private mortgage securities in the U.S. He's also one of the biggest servicers. He's got a AA rating at the bank. Why wouldn't you take his guarantee instead of Fannie? And you see, the other part of this is that if Treasury cuts a deal with Fannie and Freddie that says that they will guarantee their issuance, their conventionals, why wouldn't they do that deal with other banks? Why wouldn't they do that deal with Mr. Cooper or PennyMac? And they will. See, Fannie and Freddie as private entities can't survive because they're not competitive. I'm telling you, the non-bank issuers out there, they are hyper efficient. They buy loans. They would take all the conventional correspondent business away from the GSEs. U.S. Bank, by the way, is number 2 behind Jamie. You think they're going to sit still and just let the GSEs charge 50 basis points a year for insurance? No. So, people in Washington don't think about the mortgage market. They think about housing policy, which are two different things. But they don't say to themselves, gee, what happens to these entities, these enterprises, if we actually release them?
Yeah.
And they have to function as private companies. That's the problem.
I have kind of like a random question for you. Would you ever want to serve in DC or do something like in an administration or? I
know. I always worry about the phone ringing. That's when I run out of the house.
I don't know if they're going to go through that book. And there's probably a lot. I don't know. Just saying, would you ever be interested in that or?
Oh, sure. I've had discussions in the past. During Trump one, we talked about a couple things in housing. But, I'm happy to serve my country. I don't really care who's in the White House. As you pointed out, I'm always a witness for the court. I'm never a witness for either side.
I like that. I think that's so important.
Well, that's why I never get called as an expert witness. Sometimes I act as a consultant, but they're like, don't put Chris on the witness stand. No, he's going to tell the truth.
Well, in my book, I think that's a good thing. Always tell the truth.
You know what I would rather do is if they release Fannie and Freddie, I want to be the receiver to clean up the mess.
There you go.
That would be fun.
There you go. Oh, Chris. Okay, so I want to go back to the top of the conversation, just because you were talking about people didn't expect things to change, this kind of change, I guess the velocity of the change. Did you expect it to be this quick, or I take it probably didn't surprise you, did it?
I didn't anticipate exactly what's happening, especially in credit. We've been waiting for consumers. Hasn't happened yet.
Yeah.
But on the other hand, commercial is galloping along. The value destruction going on in corporate credit and also in commercial is just mind-boggling, and it will continue. So the thing I've been worried about is that we're going to start to see consumer behave the same way. And that's when you're in a big recession. I think that's the concern the Fed has too. They've been trying to wait to wring as much inflation as they can out, even though they could have raised rates more, frankly, to get housing inflation in line. But now I think they realize that they're going to have to relent. They're going to have to let rates go back down. And they want to go back down. If anything, the Fed's going to have to defend the floor on rates, judging by what's going on in the bond market today.
Interesting. Defend the floor. Okay, just explain that a bit more. Yeah.
Well, when the Fed was given the power to pay interest on reserves in 2008, that gave them the ability to essentially put a floor under interest rates. George Selgin at Cato Institute wrote a wonderful book called Floored for people who are interested in this. And he explains the whole history of the Fed essentially nationalizing the short-term credit markets in the United States. So you have corridors and you have floors and ceilings. During some periods, you might want to keep rates from going too high. All right, so that's a ceiling. But the floor is when you have a situation where rates want to fall, but the Fed wants to keep them up. So they pay X amount on reserves to provide a floor, if you will, for short-term rates.
Yeah. You also mentioned consumer, and that's the area that the Fed is going to be worried about. I don't know, maybe it's more like anecdotal, but like, are we starting to see that? Because like you saw like Starbucks, McDonald's, like anecdotally.
Yes.
Are we starting to is that starting to come to
It's a qualitative change.
Mm-hmm.
Are the consumers doing worse than the statistics indicate? Yes. You know this because when you talk to mortgage servicers, they're not losing money on the note. The house is worth too much money, but the family is being forced to sell the house because they can't afford to live there anymore. Property taxes have gone up, insurance have gone up, other costs. So what you're seeing is the bottom third of American households are under a lot of pressure. And these are people who already got kicked around during COVID. We've talked about this. They may have lost a job, whatever. They may have been under some kind of moratoria for their rent or their home purchase. And now here we are. The emergency's over, right? And these households are struggling. And that's what I think really worries the Fed, that they're going to see a jump in unemployment. They're going to see a jump in consumer defaults for credit cards or whatever. You know, going back to what we talked about before on Ally with the stress tests. And then all of a sudden, they're going to be in a defensive position and they're going to be forced to lower short-term rates. But here's the kicker. The long-term end of the market may not follow. So if you're a mortgage lender today, you had, $40, $50 million worth of loans in the pipeline for this month, you're going to make a ton of money now because the 10 years below 4. You were selling those mortgages into a 5.5 coupon for later this month, right? Look at that 5.5. In fact, here, I can tell you. Let me go find it. Yeah. So we're on a 3.811 this morning, and the TBAs have moved more than a point. That's good.
Well, it's good for them. It's good for them.
Well, it's good for the lenders. Lenders have been losing money on every loan they've made for the past couple of years because of the yield curve. This is going to be a nice little bump for all the lenders.
Yeah, certainly. You brought up an interesting point. Like, you might be a homeowner and the price is appreciated, but you have to step back and like, I didn't think about that. But if your property gets assessed at a higher value, that's more taxes,
Florida.
Insurance.
Your taxes.
I've heard about the Florida situation from people who live there.
That's right. Well, if you're an insurer, you're getting killed in Florida. Is it even an insurable risk? Could you price it? No. So insurers will come back once they figure out what the pricing is. But if you own a farm or if you've been living in Florida for most of your life and all of a sudden your insurance costs double, that's a big deal, especially if you're a farmer and you have to protect a business and things like that. So that's where the shock comes in with inflation. And I think there is a lot of inflation shock in this economy, Julia.
Yeah, there's certainly a lot of inflation shock. I guess one final question, like I brought this up with actually Professor Hankey, and I thought it was like an interesting answer. So maybe I'll put it to you. If you had to like grade the Fed, what grade would you give them right now? What would be your assessment of them?
I think I would give them probably a C. And the reason is that the Fed has become more and more a facilitator of the Treasury and of our fiscal situation, and less acting as an independent guardian for the public interest. Fed chairman like Arthur Burns used to threaten to raise interest rates if Congress didn't deal with the budget deficit. You don't hear anything from Jay Powell. He's mute. And I think, unfortunately, history is going to be very unkind to him because both he and Yellen and even Bernanke, they kind of did the right thing initially, but then they did too much. And they didn't let up on the gas. So we ended up with an inflation problem. And we also ended up with an environment that encouraged the Congress to follow their worst instincts. And they did. The one thing you can depend on with American democracy is that Congress will always do the wrong thing. And it doesn't matter which party you're talking about, by the way. And so here we are. We have $36 trillion worth of debt, and it's mostly funded short term. So whoever wins the White House inherits this mess. Yeah. And it's going to limit their flexibility rather considerably.
Yeah, it is certainly a mess, and we will continue to discuss this.
But we can fix it, Julia. Don't worry.
How? Okay, can we fix it, really? Do you think we can?
Oh, this country has physical assets that are worth hundreds of trillions of dollars. Don't worry about that.
Okay, wait, how would you fix it, Chris? What would be your first move?
I would cut a big deal. The big deal would be refinance the debt and create a sinking fund to pay it down. balanced budget amendment, and a line item veto. Got to do it. That's how you get this country in line. And how do you pay for it? National sales tax. You get rid of most of the income tax. You don't charge income tax to poor people. You give them tax credits, and you try and find a way to finance this country. You got to do it at the point of sale. It's all about sales, Julia. We are not about income. We are about sales.
We should have that a more extended conversation on that. I am curious, especially even like the amendment side of things too. Like we have to clean up the mess.
I'm revising Inflated, and I had to add a chapter for the last 15 years. So okay. I'm having great fun. I will have all of this codified for you by the time we talk next.
Well, we'll be talking in September. Chris, I appreciate you so much. Any parting thoughts that you'd like to leave with the audience? Also, I know you have the new book coming, so please let them know about that as well.
Oh, we have many books. Yeah, I have my biography of Stan Middleman coming out in September through Forbes Books. I have 200 copies. If you want a signed one, you got to go to the institutionalriskanalyst.com. Mm-hmm. And then, God willing, we're going to come out with a revised edition of Inflated next year. Come visit the blog, and we're always happy to have more people on X at rcwhalen.com.
I love it. Chris Whalen, chairman of Whalen Global Advisors, author of The Institutional Risk Analyst. Thank you so much. We always love hearing from you.
My pleasure,
Appreciate
Julia.
you. Be
Drink
well.
your
See you soon.
Stay cool.
So I've been drinking my Gatorade. That is true. I have been drinking Gatorade this week.
You got
anyway,
it.
I appreciate you. Thanks so much, Chris.
All right. See ya.